Welcome to the Deep Dive, the show where we cut through the noise and deliver the essential insights you need to be truly well-informed.
Today, we're plunging into the complex world of Tilray Brands, Inc.
Yeah, and the big question is this company actually charting a course to become a global consumer packaged goods giant? Or is its aggressive expansion more of a high-stakes gamble?
It's a fascinating case. By the end of this deep dive, you'll understand why Tilray's stock price currently sits right in the middle of its estimated intrinsic value.
Right, it reflects a market that's weighing enormous potential against some very, very significant risks.
Definitely.
So we're embarking on a comprehensive analysis of Tilray Brands, Inc., ticker symbol TLRY.
And just to ground us, all the financial data and assessments we'll discuss are anchored to our analysis date of June 27, 2025.
With a NASDAQ closing share price of $0.4124 on June 26, 2025.
Our mission today is really to dissect the intricate layers of this company. It's clearly at a pivotal juncture.
Absolutely. We want to help you grasp what's truly important when considering its tangible assets and market leadership against, frankly, persistent financial losses and profound regulatory uncertainty.
There's a lot to unpack.
There really is. So where do we begin with Tilray? Let's start by dissecting their actual business, what they do, and how they've tried to pivot beyond just cannabis.
Okay.
That brings us to Chapter 1, Business Analysis.
Right. So Tilray has really evolved, hasn't it, from being a pure-play cannabis firm?
Yeah, to this diversified global lifestyle and consumer packaged goods, or CPG, company.
And its business model is built on this clever four-pillar structure.
It seems designed specifically to mitigate the inherent risks in the cannabis sector while still capitalizing on growth opportunities in adjacent industries.
Exactly. So those four primary revenue-generating segments are, first, cannabis.
Right. That covers cultivation, production, and sale of both medical and adult use products. They're a key strategic focus in Europe for medical cannabis, especially Germany.
And they're the market leader for adult use in Canada.
In the third quarter of fiscal year 2025, this segment generated, over $54 million in net revenue.
That's right. Then the second pillar, and this is crucial, is beverage alcohol. It's now their single largest revenue source.
Built through some really aggressive acquisitions, made them the fifth largest craft brewer in the United States.
And this segment is absolutely central to their entire U.S. strategy. Pulled in nearly $56 million in net revenue in Q3 FY25.
Which, interestingly, actually surpassed their cannabis segment revenue.
Yeah, it did. Third, there's distribution.
Primarily through Tilray Pharma in Germany. Right, distributing pharmaceutical products.
Correct. Their second largest segment, contributing over $61 million in Q3 FY25, though importantly, with lower profit margins.
Got it. And finally, wellness.
Focusing on hemp-based foods and CBD products led by their Manitoba Harvest brand.
That segment reported over $14 million in Q3 FY25.
What's really fascinating here, I think, is how much of Tilray's strategy is about positioning itself for a future, a more favorable regulatory environment, especially in the U.S.
That's a great point. This isn't just diversification for diversity's sake.
No, it's a calculated survival strategy. Tilray is using its booming beverage alcohol sales as a crucial lifeline. It's essentially funding its cash-burning cannabis ventures while, playing the long game.
Absolutely. And a truly critical emerging revenue stream you have to mention is their hemp-derived THC beverages in the U.S.
Ah, yes, leveraging what's seen as a loophole in the 2018 U.S. Farm Bill.
Exactly. That bill legalized hemp with less than 0.3% Delta-9 THC, and Tilray has used that to launch low-dose THC beverages.
Strategically establishing a brand presence and distribution network in the U.S. before potential federal cannabis legalization.
Right. This initiative, while still small, around $1.4 million in revenue year-to-date as of Q3 FY25, has already expanded to over 1,000 retail stores.
It's their strategic Trojan horse into the largest potential cannabis market.
Precisely. And just to give you a sense of their product diversity, in cannabis they offer things like whole flower, vapes, THC-infused beverages under brands like Good Supply. In beverage alcohol, you'll find names like Sweetwater Brewing, Montauk Brewing, even Breckenridge, Distillery Bourbon Whiskey.
Quite a range.
And their wellness segment, via Manitoba Harvest, offers hemp hearts, CBD supplements, and those new hemp-derived THC drinks. They're low dose, positioned as a way to unwind without getting them high or drunk.
Interesting positioning.
In terms of market position and scale, Tilray is truly global now. market cap around $400 million.
And trailing 12-month revenue, that's TTM revenue over the last year, hitting nearly $800 million.
Employing about 2,650 people worldwide, operating those GMP-certified facilities in Canada, Portugal, and Germany. That's crucial for quality control, especially in medical markets.
Definitely. And they hold the #1 market share in Canadian cannabis, over 13% after the Hexo acquisition.
They're dominant in European medical cannabis, especially Germany, and as you said, 5th largest craft brewer in the U.S.
So if we connect this to the bigger picture, Tilray's value proposition is really about being a diversified, sort of de-risked business.
Designed to capture both immediate revenue and significant future optionality.
Their stated mission is ambitious, to be the most responsible, trusted, and market-leading cannabis consumer products company in the world.
Exactly. And this involves a two-pronged strategy. First, generating immediate revenue from legally permissible markets, Canadian adult use, European medical, and critically, U.S. beverage alcohol.
Right. That diversification is a defensive maneuver. Generate cash flow, de-risk from the uncertainty of U.S. federal cannabis legalization.
And as you pointed out, the beverage alcohol business is essentially funding their cash-burning cannabis operations.
Which leads directly to the second prong, building that Trojan horse for U.S. market entry.
Yeah, the U.S. beverage and wellness acquisitions are building this comprehensive CPG platform, established brands, national distribution, invaluable consumer data.
All legally built and scaled, ready to be leveraged for high-margin THC-infused products the moment U.S. federal legalization or rescheduling happens.
It creates this massive, yet-to-be-realized call option on the U.S. cannabis market that few competitors can match.
It's essentially a huge bet on a future regulatory shift.
Looking at the industry itself, the global recreational cannabis market is projected to grow. Around $2.8 billion in 2025 to $5.5 billion by 2034.
Yeah, about a 7.6% compound annual growth rate, meaning expected growth of about 7.6% each year on average.
And the broader cannabis cultivation market is forecast to expand even faster.
Key trends include a shift towards value-added products, beverages, edibles, wellness items.
Advancements in cultivation tech and evolving consumer demographics, with millennials and Gen Z driving trends.
And that U.S. hemp-derived THC drinks market alone is expected to reach nearly $750 million by 2029, so potential there.
But the competitive landscape is intense, fragmented.
Oh, absolutely. Tilray faces direct rivals like other large Canadian LPs, Canopy Growth, Aurora, future U.S. MSOs, even large CPG companies potentially moving in.
And you can't ignore the crucial competitive pressures from the persistent threat of the illicit market,
which undercuts legal prices due to lack of regulation and taxes. That, coupled with widespread price compression in mature legal markets like Canada.
Because of oversaturation. It really squeezes margin.
Definitely.
And you simply can't talk about this industry without discussing the regulatory environment. It's the defining and most challenging characteristic.
Absolutely. The biggest hurdle, U.S. federal prohibition cannabis as a Schedule I controlled substance.
Which prevents interstate commerce, restricts banking and capital.
And imposes that punitive IRS code, Section 280E.
Right, Section 280E. It's worth quickly explaining that. It's a tax code that prevents cannabis businesses from deducting ordinary business expenses.
Meaning they pay taxes on gross profit, not net profit. It just cripples profitability for legal operators.
And while there's a slow, inconsistent global legalization trend, like in Germany,
it creates opportunities, sure, but also substantial risk because business plans rely so heavily on political action, which is unpredictable.
So barriers to entry are primarily regulatory and financial.
Capital scarcity is huge. Limited access to traditional banking forces, reliance on more expensive capital.
The regulatory and compliance burden is monumental, often described as a compliance nightmare. High costs for licensing, legal counsel.
And then market saturation, especially in Canada, leads to intense competition, and that price compression we mentioned makes it hard for new players to break through profitably.
Tilray's competitive advantages are, well, interesting. Their brand strength is a core pillar over 40 brands, including top Canadian cannabis brands like Good Supply.
And well-known U.S. craft beer names like Sweetwater. The goal is to extend that loyalty to cannabis post-legalization.
Theoretically, their global scale and those large mergers, Aphria, Episo, should provide advantages and synergies.
But that's precisely the critical point, isn't it? If the strategic intent was scale and cost advantages, why haven't we seen it reflected in their financials?
Good question. The persistence of large operating losses suggests these theoretical benefits. Well, they've been overwhelmed.
overwhelmed by immense integration costs and fierce competition. It's a classic CPG playbook, grow by acquisition, clashing with the brutal realities of the cannabis industry.
You're absolutely right. In terms of network effects or switching costs for consumers, they're minimal.
But the key network for Tilray is their established business-to-business distribution network in the U.S. beverage market.
Right. Relationships with thousands of retailers, including major players like Total Wine and more. That is a formidable barrier to entry for competitors if cannabis becomes legal federally.
And finally, their unique assets, that global, vertically integrated platform across 20-plus countries.
The EU GMP certification for Portugal and Germany, crucial for the European medical market.
And that U.S. beverage infrastructure. Top 5 player, an unparalleled legal entry point for future cannabis integration.
Okay, so with that foundational understanding of their operations, let's shift focus. Let's look at the leadership team steering this complex ship.
Right.
We'll dive into Chapter 2, Management Evaluation.
The assessment here primarily focuses on CEO Irwin D. Simon.
His pre-Tilray success at the Hanes Celestial Group, building it into a multi-billion-dollar global leader, definitely gives him significant CPG credibility.
And in the cannabis space, he orchestrated the Aphria merger in 2021 to create the new Tilray Brands, making it, at the time, the largest cannabis company by revenue.
Now, here's a critical challenge, though. Despite this growth and his experience, Tilray has accumulated a staggering $3.1 billion in total losses under his leadership.
And the stock has plummeted about 85%. That's significant.
It is. In response to financial pressures, they sought shareholder approval for a reverse stock split to regain NASDAQ Q compliance, though they've paused its execution for now.
And in Q3 FY25, they recorded that stunning $700 million non-cash impairment charge.
Which is essentially admitting they overpaid for assets based on prior, more optimistic expectations for cannabis legalization.
Regarding communication transparency, Tilray does offer regular communication and detailed financial reporting by segment.
But there's a notable optimism gap, wouldn't you say?
I think so. The CEO's highly bullish long-term vision, remember the $4 billion revenue plan from 2021, often contrasts sharply with the reality of persistent financial underperformance, revenue misses, and downward guidance revisions.
And they rely heavily on non-GAAP adjusted EBITDA to present a more favorable view.
Right, and it's important for listeners to understand that non-GAAP metrics often exclude real costs like stock-based compensation, restructuring, those big impairments.
Which can create a significant discrepancy with their deeply negative GAAP net income, the actual bottom line measure of profitability.
On the ethical side, though, they do have a public commitment to ethics, a code of conduct, and no major ethical scandals have surfaced.
Okay, when it comes to capital allocation, how are they spending their money?
Overwhelmingly focused on growth through acquisition rather than direct shareholder returns.
We saw that with the Aphria merger,
Yeah.
the Hexo acquisition for Canadian market share, and those aggressive U.S. beverage acquisitions. Sweetwater, Montauk, brands from Anheuser-Busch, and Molson Coors.
But it's crucial to note no history of share buyback programs here.
Instead, there's been significant ongoing shareholder dilution to fund acquisitions and operations.
And they do not pay a dividend. All capital is reinvested for growth.
This brings us to a really uncomfortable truth, I think. Their return on invested capital, or ROIC.
Yes, this is a major point of concern. It's consistently and deeply negative, roughly minus 5.5% over the last year.
Minus 9.4% median over 3 years, and nearly minus 16% average over 5 years.
If we connect this to the bigger picture, a negative ROIC means the company is literally destroying shareholder value.
For every dollar they've invested, they're generating an operating loss.
It directly challenges the effectiveness of that aggressive M&A strategy, suggesting capital deployment just hasn't yielded profitable returns. The CPG playbook is clashing hard with cannabis industry realities.
With that stark financial reality in mind, let's pivot. Let's dig into the numbers themselves in Chapter 3, Financial Analysis.
Okay, let's look at the figures.
As of June 26, 2025, the share price was about $0.41, market cap covering between $400 million and $416 million.
Trailing 12-month revenue close to $800 million.
In Q3 FY25, their consolidated gross margin was 28%. But that operating margin in Q1 CY25, wow, negative 409%. heavily impacted by that huge impairment charge.
And the TTM net margin is also deeply negative at max 114.4%, persistent losses.
They have a relatively low debt-to-equity ratio around 0.10.
But that can be a bit misleading, right? Because equity's been inflated by billions of newly issued shares and all the goodwill from acquisitions.
True. Their current ratio, though, is healthy at 2.6, shows strong short-term liquidity.
And about 1.02 billion shares outstanding now, reflecting that dilution.
Yeah. Looking closer at those profit margins. While the cannabis segment showed a strong gross margin of 41% and beverage alcohol was 36%.
The consolidated gross margin was a more modest 28% in Q3 FY25.
More critically, their operating margin is consistently and deeply negative, even before that massive $700 million impairment.
It clearly indicates an unsustainable cost structure. They're just burning through cash operationally.
And the net margin reflects that too deeply negative long history of substantial GAAP net losses.
Which leads us to free cash flow generation.
Consistently negative. They're burning cash quarter after quarter. In the last reported quarter, Q1 CY25, it was negative nearly $20 million.
Management did highlight positive adjusted free cash flow in FY 2024, but...
Right. It's important to view non-GAAP metrics like that skeptically. They often paint a rosier picture than the actual cash coming in or going out based on standard accounting.
Okay, so financial stability overall.
Well, earnings show consistent unprofitability. Regular misses on analyst EPS estimates.
The debt-to-equity ratio looks low, but as we said, that's skewed. Management has prioritized debt reduction, cutting $76 million in FY25, which is a positive step.
Definitely. And their current ratio is healthy at 2.6. That indicates strong short-term liquidity, with over $248 million in cash and marketable securities as of Q3 FY25.
That cash reserve is a crucial survival tool, gives them runway in this challenging environment.
Absolutely. And as for dividends, they don't pay one. No plans to. All focus is on reinvestment.
Now, valuation analysis. Standard relative valuation metrics. They paint a challenging picture.
Price to earnings, PE ratio, negative. Unusable due to the losses.
Price to sales, PS ratio, is low, around 0.38 to 0.81. That's a dramatic collapse from over 1.8 just a year prior. Signals deep market skepticism.
And their price to book, or PB ratio, is exceptionally low. Suggests the market doubts their assets will generate adequate returns.
Compared to peers like Canopy or Aurora, Tilray often trades at or near the bottom of the industry on these metrics.
So we ran an educational discounted cash flow, or DCF, model. This tries to estimate a company's intrinsic value based on projected future cash flows.
And what did that suggest?
It projected an estimated intrinsic value range of 0 to 30, 65, 65 cents per share.
A pretty wide range.
It is. And it's crucial to remember this is an estimate, not a prediction. The wide range reflects profound uncertainty.
What were the key assumptions driving that?
We used a 10-year forecast period. Assumed a 10% average annual revenue growth rate for the first 5 years, which is somewhat conservative given recent downward revisions. A terminal growth rate of 2.5% long-term.
And the margin assumption. That's key.
Hugely speculative. We assumed a 10% target operating margin by year 10, heavily contingent on successful U.S. cannabis market entry and profitability improvement.
And the discount rate, reflecting the risk.
Exactly. We used a relatively high discount rate, a WACC of 9.5%, reflecting the high-risk profile of Tilray and the cannabis industry in general.
Okay, that makes sense.
So that covers the company's foundation, business, management, and financials. Now let's shift our focus to how the market is perceiving all of this, starting with Chapter 4, Market Sentiment.
Analyst price targets and consensus ratings seem ambivalent, maybe?
Yeah, the overwhelming consensus is hold or neutral. Over half recommend holding, only a small percentage suggest a buy. Average price targets range from around 93 cents to $1.35.
But what's really striking is the forecast range itself. It's incredibly wide, from a low of 60 cents to a high of $3.
Exactly. It perfectly reflects those binary future scenarios. The lower end likely models a continuation of the current struggles,
while the higher end is clearly predicated on that massive catalyst, U.S. federal legalization fundamentally transforming the company's prospects.
And the recent news, the general media tone, it feels quite fractured.
Creates a confusing narrative for investors, doesn't it?
It does. On one hand, you have negative coverage focusing on the financial underperformance Q3 revenue miss, that huge net loss from the impairment, downward guidance hitting 52-week lows.
But counterbalancing this are positive stories highlighting the strategic vision. The U.S. hemp-derived beverages, new beverage acquisitions, medical research, international expansion.
So the market is essentially getting two conflicting stories at the same time.
What about market indicators like short interest?
Short interest as a percentage of float is exceptionally high. Over 121 million shares shorted last we checked.
Which represents more than 13.5% of the float. That's significant, even for this sector.
Yeah, and the days to cover recently exceeded 8 days. That signals deeply bearish sentiment in a very crowded short trade. People are betting against it.
And the price relative to moving averages?
The share price, around $1.41, is trading below both its 50-day moving average.
And significantly below its 200-day moving average.
Both are classic bearish technical signals indicating negative short to medium-term momentum and a sustained long-term downtrend on the chart.
Okay, so who actually owns Tilray? What does that tell us?
Good question. Let's move to Chapter 5, Ownership Structure.
Institutional ownership patterns. Are they high or low?
Exceptionally low. Only about 9.35% of outstanding shares are held by institutions.
Wow, that suggests most professional asset managers are largely avoiding the stock.
Pretty much. While top holders like Vanguard and BlackRock are on the list, they hold relatively small positions, and some, like Morgan Stanley, significantly reduced their stakes recently.
So it's very diffuse institutional ownership. No single large institution to really anchor the price or exert influence.
Exactly. And what's even more telling, perhaps, is the insider holdings.
How much skin do they have in the game?
Extremely low. A minuscule 0.681%.
Really? That low?
Yeah. CEO Irwin D. Simon himself owns only about 0.38%.
The absence of substantial open market buying from executives, especially with the stock price at multi-year lows, that's a powerful signal to the market and not a positive one.
It really is telling. And the most striking feature of Tilray's ownership structure.
Let me guess. Retail investors.
Bingo. Heavy concentration in the hands of the general public, retail investors, holding approximately 90% of the shares.
Which is often seen as a bearish indicator, right? Implying a lack of conviction from informed market participants.
Often, yes. And it can contribute to higher volatility. This situation largely stems from the company's funding strategy, that persistent shareholder dilution we talked about.
Which is directly at odds with creating per-share value for existing holders.
Precisely. Okay, let's move on to Chapter 6, Risk Assessment. We'll break down the key strengths, weaknesses, opportunities, and threats. The classic SWOT analysis.
All right, let's start with strengths.
Okay, strengths. Diversified portfolio, over 40 strong brands across different sectors. Global scale and distribution, #1 Canadian LP, European medical leader, top 5 U.S. craft brewer.
Unique strategic assets like those EU GMP certified facilities and the robust U.S. beverage distribution network.
And healthy short-term liquidity, that $248 million cash cushion.
Now the weaknesses. We've touched on these. Chronic unprofitability and persistent cash burn. Long history of deep GAAP net losses.
Value-destructive capital allocation shown by that consistently negative ROIC.
High operational costs and integration risk despite claims of synergies from mergers.
And that history of significant shareholder dilution, actively eroding per-share value.
Okay, but the opportunities are potentially massive, right?
They really are.
Yeah.
U.S. federal legalization or rescheduling is the single biggest one. The potential game changer.
Unlocks the world's most lucrative cannabis market, offers significant tax relief from that crippling IRS Code 280E.
Huge potential impact. There's also international market growth, especially in European medical cannabis.
And continued product innovation, particularly in those strategic hemp-derived THC beverages.
But then, the threats. They are substantial.
Intense competition and that punishing price compression from hundreds of LPs and the persistent illicit market.
Profound regulatory and political uncertainty. Their future depends so heavily on unpredictable legislative changes.
And as a CPG company now, they face the constant challenge of rapidly shifting consumer preferences. Tastes change.
Definitely. We should also touch on the impact of key macroeconomic factors. Inflation, interest rates. How do they affect Tilray?
Significantly. Inflation directly pressures revenue, as cannabis is often seen as a discretionary product. Reports suggest over 66% of consumers are spending less due to inflation.
And it drives up input costs, energy, raw materials, transport, squeezing already thin margins.
Higher interest rates are particularly damaging for this capital-intensive, unprofitable industry. higher borrowing costs for the private debt many rely on.
There's talk of a potential industry debt crisis as billions in loans mature around 2026.
Right. And it makes funding M&A more expensive too, so these macro headwinds really amplify their internal weaknesses.
What about specific geopolitical factors, like, say, hypothetical U.S.-imposed tariffs?
The direct impact on Tilray's core cannabis products would likely be minimal, simply because there's currently no legal cross-border trade of THC products from Canada to the U.S.
Okay.
However, there's a more significant indirect impact risk on the ancillary supply chain, things like equipment, packaging imported from or through the U.S., that could increase production costs.
But Tilray's management believes these tariffs wouldn't materially impact sales.
Yeah, they cite their localized supply chain strategy. U.S. beverages made in the U.S., Canadian cannabis in Canada, European products in Europe. That diversified, regionalized footprint acts as a strategic hedge against such global disruptions.
Makes sense. Okay, we've covered a lot of ground. Let's bring it all together. Finally, we arrive at our comprehensive summary, Chapter 7. Conclusion.
Let's synthesize these findings. Start with the bull case for Tilray.
All right. The bull case rests on unmatched global scale and market leadership across both cannabis and beverages.
A diversified and seemingly de-risked CPG model, providing more stable revenue streams than pure cannabis.
Massive in-the-money optionality on U.S. legalization via that Trojan horse U.S. beverage platform.
A strong and growing portfolio of over 40 recognized consumer brands.
And, critically, sufficient liquidity to execute its long-term strategy without facing an imminent crisis. They have runway.
Okay, now the bear case. This is grounded more in the current financial reality.
Right. It highlights chronic unprofitability and persistent cash burn with no clear path yet to sustainable profitability.
A track record of value-destructive capital allocation clearly demonstrated by that consistently negative ROIC.
Intense competition and punishing industry headwinds, including the illicit market and the burden of IRS Code 280E.
Massive shareholder dilution over time, and a profound lack of confidence reflected in the low institutional and insider ownership.
And finally, an over-reliance on an unpredictable binary catalyst, U.S. federal legalization, which is entirely outside the company's direct control.
So bringing it back to valuation, our educational DCF model yielded that estimated intrinsic value range of $3.30 to $65 per share.
And the current share price, as of our analysis date, was approximately $0.41. That falls squarely within this estimated intrinsic value range.
Which suggests the market is currently pricing the stock to acknowledge both the significant near-term risks and the potential, albeit highly uncertain, long-term rewards. It's bounced on a knife edge, you could say.
It really seems that way.
So this raises an important question for you, the listener, to consider. For Tilray to be considered fundamentally undervalued from this point, what specific changes would you need to see? Changes in its financials, perhaps? Or in the regulatory landscape? What would shift your perception of its potential?
That's the key question.
Because at present, an investment in Tilray remains, frankly, a highly speculative bet on future regulatory change and a significant operational turnaround, rather than an investment in a currently stable, profitable enterprise.
That was truly a deep dive into Tilray Brands, Inc. Hopefully that gives you a much clearer picture of its complex journey.
We hope you feel much more informed and ready to think critically about its future.
Definitely. If you found this deep dive valuable, remember you can get more expert analysis like this from Stock Analytics AI, who prepared the detailed report we've just discussed.
Consider liking and subscribing to their YouTube channel.
For just €4.99 a month, members get priority deep dives on specific tickers. And over the next few months, they're covering all of the S&P 500 stocks. Members get exclusive priority access to those.
And if you just want a one-off deep dive on a specific company you're interested in, you can drop them a super thanks.
Right. And just the standard disclaimer. As noted in the source material, this analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice.
Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Thank you for joining us on the deep dive. We'll be back soon with another fascinating topic for you to explore.